Welcome to TradingPennies.com Chart of the Week, where every week we will examine the trading strategy behind one of our explosive daily stocks picks. All of our strategies are covered in detail in our manual. Learn how professionals trade the penny stock market, available on our site at trading-pennies.com. This week's chart is Triad Guaranty Inc, ticker symbol TGIC, a provider of private mortgage insurance coverage in the United States to residential mortgage lenders and investors. What caught our attention in this stock was the recent quiet accumulation above the slowly ascending 20-period moving average on the daily chart from a long, non-volatile basing pattern in a sector that has shown some recent improvement in the larger market. As noted in our manual, we always refer to the intraday price volume action and its relationship to the 200-period moving average for both entry and exit signals. Our favorite entry signal is a volume breakout from and pullback into the ascending support of the intraday 200-period moving average in a stock with little immediate overhead resistance. It is this signal we saw on opening trade on April 30th and where we took our initial position. As in any time period, one of the most reliable entry points for profit is taking position in a stock in the initial pullback from a breakout such as this, and this is what we look for to increase our position. The traditional entry in a continuation move is to take position in the stock as it clears the high of the original breakout on volume. We at Trading Pennies like to minimize our risk and buy into the volume as the stock pulls back into and then moves off of the support of the intraday 200-period moving average on increasing volume on the ask. Seeing this occurring in Triad Guaranty Inc in mid-afternoon trading on May 1st, we added to our position. As always, once taking any position, we quickly turn to exit strategies and perform multiple time frame analysis looking for potential resistance levels, as this is always a concern of a trader when determining the risk to reward potential for any trade entered. On the monthly chart, the most prominent patterns we saw were that of simple price level resistance points. Our first resistance, now turned support, was the initial breakout of the 0.33 price level. The second, that we viewed as significant, was the 0.50 price level, as it served a point that turned the price advance away on 3 prior occasions and represents a natural price level resistance point in the minds of the majority of penny stock traders. The third was the 0.72 price level, as it served a convergent point of both price resistance on 2 prior spike lows, as well as a 10-period moving average on the current candle. The fourth was another price resistance level at the 1.09 price level. On the weekly chart, we saw price level resistance levels at the 0.50, 0.66, 0.88, and the 1.20 price levels. Of note was the pattern convergence at the 0.88 price level as both a price resistance level and the current price level of the overhead and descending 40-period moving average, which has become a significant moving average on the weekly charts to many traders over the past couple of years. On the daily chart, there were a number of pattern points of resistance. On a price level basis, the 0.50, 0.66, 0.88, and the 1.09 were significant. Another significant resistance point was the overhead and descending 200-period moving average at the 0.85 price level, which on the daily chart is considered significant by the majority of traders. As such, on a price level basis, the 0.50 was the most significant and immediate resistance point as noted in multiple time frame analysis, and what we considered a major pivot point. Other noted resistance points were the 0.66, 0.85, and 1.09 price levels. Also noted on the daily chart were a 30-degree and 45-degree up channel drawn off the lows of the recent breakouts. Of interest was the convergence point at the 0.63 price level. This plus the price level resistance at 0.66 gave this range significance in the short term. As noted in our manual, professional traders look for convergence points amongst the various chart patterns not in single time frames, but simultaneously in multiple time frames as professionals think three-dimensionally, anticipating truly significant key pivot points in which to both enter and exit positions. It is at these key pivot points where the greatest volume of traders waiting to take action will be the greatest, and points where market psychology is more apt to suddenly shift and as such a trend of one's position. Thus, as a stock moves into these key pivot points, we closely watch the price volume action, letting it, not what we project onto the market, dictate our course of trading action. We now had a significant position in Triad Guaranty Inc, and the stock exploded upwards on volume not soon after we added into our position in the mid-afternoon trading of May the 1st. Due to the significance of the overhead 0.50 price level, we were prepared to exit the majority of our position should the stock continue to the upside. Our rationale was that the price volume action was almost vertical at the time and suggested a volume climax. The degree which the price level relative to the underlying support of the 200 period moving average was extended and therefore likely to snap back to the norm, and the stock had made a 50% advance, and this by anyone's standards is a significant and unlikely sustainable move. But the price vaulted past the .50 price level with little evidence of distribution. As such, we exited a minority position into the upside volume and set our stop loss at the .45 price level, as this represented a small intraday consolidation prior to a vertical price expansion. There was a small consolidation underneath the resistance at the .50 price level, and volume once again came into the stock, causing it to gap to the upside. The question was the gap an indication of a volume climax or a continuation gap play? To this, our line in the sand was raised to the .50 price level. A fill of the gap would indicate the likely end of the move, and we would exit the remaining position. If the gap held, it would suggest a continuation gap and an equal move to the upside. To this, we quickly used pattern projection to see the most likely upside target. Subtracting the low from the high of the initial breakout, and then adding this to the low of the current pullback, we derived an upside target at the .73 price level. We saw this as likely as it corresponded to one of the resistance price level points on the monthly chart, and as such, a new key pivot point to watch price volume action. To add significance to this level, we drew trend lines off of the lows of the current price expansion and noted the formation of a 60-degree upside channel, the upper boundary of which demonstrated pattern convergence at the .73 price level. As noted in our manual, the most stable up channel is the 30-degree, the least the 60-degree. As such, we plan to exit a majority portion of our position should this pivot point be reached, and use the lower boundary of the channel as our stop loss point, as the stock was too far extended above the intraday 200 period moving average, which we traditionally use as our stop loss, and as such, too much profit would have to be sacrificed. The stock hit our target, and we sold a major portion of our position. With our remaining position, we maintained the lower boundary of the 60-degree up channel as our trailing stop loss point. The stock began to form a tight bull pennant consolidation, so we quickly used this and drew another pattern projection target, which suggested an upside move to the .88 level. As noted previously, the .85 to .88 price level represented a pattern resistance level on both the weekly and daily charts, and where we plan to exit the remainder of our position. The underside of the forming bull pennant was not broken, and the consolidation remained in the upper half of the 60-degree up channel, and therefore favored continuation to the upside. Triad Guaranty Inc. broke out of the consolidation to the upside, and in so doing, the upper boundary of the 60-degree up channel. With this, we drew an even steeper channel based on the lows of the current breakout. This is represented in magenta. We used the upper boundary as a point in which we would exit the bulk of the remainder of our position, holding on to all but a very small portion, and the lower boundary as our trailing stop loss point. The upper boundary was hit at the .85 price level, and where we exited the bulk of our position as the stock consolidated around this key pivot point. We maintained the lower boundary of this almost vertical channel as our stop loss point, using the same rules we have with regards to described in our manual with regards to the 200 period moving average. We will sell our position if this, in the case of the lower boundary of the up channel, is broken by 2 consecutive candles or on a single candle on significant volume. High volume came into the stock once again, and it broke out of the consolidation to the upside once again. In our history, we have usually found that when stocks explode to the upside, and everyone, including their mothers, are trading, a stock seems to be pulled to significant price levels for no apparent reason, such as the .50, .75, 1.00, 1.50, or 2.00 price levels, as if it was by the will of the traders alone. As such, we saw the 1.00 price level as the point being likely reached, and we decided to exit the remaining position should it be reached. Being that the next significant pivot point was the 1.09, we felt comfortable that the volume of shares we had remaining had a high probability of being bought at the 1.00 price level. The stock vaulted once again, and our remaining position was taken out at the 1.00 price level. Triad Guaranty went on to hitting the projected target of 1.09, forming the classic volume climax. As noted in our manual, volume climaxes are highly predictive of an imminent change of trend. This pattern is characterized by a sudden dramatic increase or spike in both price and volume in the prevailing trend, only to retreat on lighter volume as seen in late intraday activity. Volume climaxes become more predictive towards the end of a long move as they hit near significant resistance levels. Classically, those that hold on to these extremes, anticipating further continued price movement, do so based on greed, and thus the basis of the saying, bulls make money, bears make money, but pigs get slaughtered. Some would say the action we took was an example of trading like a pig. To the contrary, we understood the nature of what was happening, feathered out of our position at key pivot points as the risk increased, and obeyed our rules of entering and exiting the trade. If you're interested in learning the principles of successful trading, they are clearly outlined in our manual, Learn How Professionals Trade the Penny Stock Market, available on our site at tradingpennies.com. Until next week, from tradingpennies.com, this is Thomas McClellan, where our goal is to help you learn to become successful trading the penny stock market.